Welcome to the FarrCast, providing you insight into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It's the 20th day of March. Susan, I was so glad to see you in the supermarket. Thanks for the shout out about the FarrCast. We're going to try and get it out earlier to you. Heard that the FarrCast is coming across a little late. We're going to get it out early to you. God bless you and all of our listeners out there. All right, what are we seeing this week that we weren't seeing last week? Couple of things. We're seeing a couple of things. Of course, we continue to see tariffs, and President Trump says that tariffs on Canada are, in fact, going to take effect on April 2nd. April 2nd is the day. I continue to feel like we're beating up on a golden retriever here. I don't know why we have the fight with Canada. I can't figure it out. I just can't. I don't see it. One thing I know is people ask me what's going to happen with markets and what's going to happen with the economy. I go back to that John Maynard Keynes line that says, listen, when the data changes, I change my mind. What do? If you change this tariff news, if you change the numbers and the taxes and the everything else, then I've got to give you a change about my outcomes. But if you keep everything consistent, all of these tariffs in place, and maybe throw around a couple of more, and also some speechifying, bombastifying about additional ones that never happen, you keep an unstable situation or outlook. Outlook is really important. You keep an unstable outlook for the economy, but right now you keep all of those things in place, it's a lower, more negative view, right? It's a contractionary view. These are big headwinds to economic growth, and that's that. And if the president somehow thinks that he can cause a quick, sharp recession from which he can recover in times of the midterms, I've said before, it feels to me like playing Russian roulette with 5 bullets in the gun. Nobody can call the economy that closely, and nobody certainly can cause parts of actions within that economy to actually play out according to your desired calendar. I'm telling you, it just doesn't happen. Can't do it. Forget about it, as my friend Polcari would say. What we learned from Jay Powell with the Fed meeting, we learned a couple of things. Got some numbers coming down here to my point. Fourth quarter 25 GDP now is now up 1.5 to 1.9% compared to 2024, which was up 1.8 to 2.2. So that's lower, right? It's lower. Unemployment rate estimates 4.3 to 4.4. It was 4.2 to 4.5. That's not a lot changed. PCE inflation is a little higher, 2.6 to 2.9 versus 2.3 to 2.6. That was the December projection. So we've gone from 2.3 to 2.6, now to 2.6 to 2.9 for that inflation number. Core also higher, same way. It was 2.5 to 2.7 inflation, now 2.7 to 3. And the median projection for Fed funds target rate remained unchanged at 3.9%, median projection. So those numbers for inflation are moving up. For growth are moving sort of slightly lower, well, definitely lower, but still slightly lower. So this is a sign that these numbers are having an effect. And I'm worried that Jay Powell is going to be skewered for saying that the tariff policies are indeed showing up in the economic data already, and certainly in the projections. So when you look at all of that, you have to figure out how you're going to invest. And we've invested through expansionary periods and contractionary periods. I'm almost done, folks, almost done. Expansionary periods economically, contractionary periods, inflationary periods, deflationary periods, and long-term investors survive. Just ask Warren Buffett. What you need is a plan. What you need to plan for, first and foremost, is that this will be emotional. If you're already feeling emotional, then I don't need to convince you. If you're not yet feeling emotional, I would suggest maybe you better pay closer attention, but you need to avoid those emotions. It's not a matter of how you feel. It's a matter of what the numbers are, and if they're going down, fine, and if there are opportunities, good. But as long as you stick with your long-term plan, you're going to be okay. because we cover Wall Street, Washington, and the world. And we're starting with my friend, Kenny Polcari, Case Capital Advisors CEO, Slate Stone Wealth Chief Market Strategist, and the face and voice of Fox News. Welcome back, Kenny.
Well, thank you for having me. I didn't ever think I was going to get a word in after that beautiful introduction you made.
You know, I try to set the stage, KP, and say, here's where we are this week. And it really is, oddly, a lot different than it was last week. It's a lot different. And there's a lot different on the political side, too. I got to get to Mahaffee here.
Yeah.
What does it mean when the president of the United States starts saying, there's a judge order? I don't care. I'm going to ignore the courts.
Wait, Biden did the same thing. The Supreme Court told him, no, he couldn't do the student loan thing. And he said, well, I don't care what the Supreme Court says. I'm going to do it anyway. So why is it suddenly an issue if President Trump says, I'm going to ignore this judge?
I'm going to ask Mahaffee exactly that question. That question. But, when Biden does it, or when Trump does it, or any president does it, it makes Farr pretty damn nervous.
Okay.
You got to have courts,
I hear
right?
you.
You got to listen to the courts.
I hear you, but Biden did it with the Supreme Court. Trump only did it with some local district judge. He didn't do it against the Supreme Court. He did it with a low-level district judge who's trying to get in the way of presidential policy. Saying, no, you can't do that. The guy's trying to make a name for himself. It's baloney.
This is an interesting argument. That guy killed 20 people, and my guy only killed 10 people, so my guy's not as bad as that guy. I mean, that's a little. Let's. Hey, how about we find guys that don't kill people? Okay.
Yeah. Right. Anyway,
now
let's talk about what happened. So,
thank you for your political view. You got anything to say about markets?
Yes. Let's get off the politics and go right to markets. Listen, what makes me a little bit nervous about what we heard from yesterday is that Jay Powell used the transitory word again.
No kidding. I know. I saw the same thing.
He said the tariff, any impacts from the tariffs would be transitory. And then he goes, but maybe not.
Well, they're transitory if the tariffs are transitory. If the tariffs aren't transitory, then the effects.
Okay, 100%. But just the fact, like that word causes me PTSD, right? Because for a year and a half, he told us inflation was transitory as it marched higher and higher and higher, and it choked you and me and everybody else. Right?
Yeah.
But he kept saying, don't worry about it. It's transitory. It was not transitory. You knew it. I knew it. Everybody else knew it. Anyway. So that was number one that got me.
Actually, okay, but you know what, Kenny? I think ultimately over the long term there, part of it was transitory. The supply line disruptions were transitory. They just took longer than we thought. And he also got wrong that the inflation that was coming from all of the cash that was sent out by the government, that cash would go away sooner, and that would be transitory. That cash lasted a long time. Well, they sent a lot of it out. And the supply chain disruptions around COVID, they kind of passed. So it wasn't, I don't think that he got the just wrong. He got the timing completely off.
Well, he got the timing wrong, right? He got the timing wrong, and I agree with you. But you can't, when inflation went from 1.6 to 3.2 to 3.8 to 4.6 to 5, you can't keep saying every month, oh, it's just transitory. It's keep marching higher and higher, and you and I felt it. So just stop using the word.
So if using the word transitory is somehow code, I don't think it is, because I don't think that Jay Powell actually wants to walk in front of Trump's crosshairs, right? He's just trying to do his job and not get in front of the crosshairs. He would love to stay out of the discussions with the president on tariffs and everything else, and just try and keep the economy on track, fulfilling his dual mandates. So Ken, we've talked about investing. We've had markets that are still very high, very volatile, and we see this seesaw back and forth, don't we, between value and growth. One day all the tech stocks are up, then all the Dow stocks are up and the tech stocks are down, NASDAQ stocks are down, and it's a seesaw thing. For the past several years, it's been an incline line that's moved up in unison, meaning that the short end, the less volatile stocks of the Dow have moved up, but they haven't moved up as much as the NASDAQ stocks. And so they've all been moving up, but the NASDAQ stocks moving up more. Now it's this seesaw bounce back and forth thing, and it's causing Dramamine sales to rise. Do you think that the Mag 7 are over with? Do you think we should abandon and forget about this? Are we a beginning of some big rotation out of NASDAQ and tech stocks and everybody needs to go buy guns and butter?
100% no. Now, does that mean that I don't think that the mag stocks may lag for a little bit because they so outperformed for a couple of years? So you may actually see them kind of retreat and churn and lag a little bit, but I don't think that AI story is over at all. In fact, I think it just continues to grow and grow and grow and become more important. So I don't think you people should be getting out of mag stocks. I think you might stay with your current positions and just kind of let them sit and work for you, and then look to focus other parts of the market that will and have been showing some strength. And you can see that, right? Look, energy is up another 8.5% this year. Utilities are up nearly 4.5%. There is activity. Healthcare is up 7%. So there is other activity in parts of the market that investors need to understand.
You know, one of my main sales guys yesterday said, hey, it's time to go talk to back all of those clients and prospects who didn't sign up with us over the past 2 years because we were too sleepy. A couple have called him, and boy, the higher risk, higher beta, higher volatility is not playing well anymore with a lot of those clients. And this is a time when clients look up and say, hey, I think I want to talk to the tried and true conservative guy who isn't going to have me out there swinging for the fences. I just 100%. Need to make sure I have my money. I want to make sure that I can retire. I'd like to leave an inheritance to my kids, and I'd like to fund some philanthropy. And I don't need to own the hottest new dot on the board. Just keep me safe, keep me growing, and I'll be a happy person. Are you hearing any of that, Kenny? But I mean,
yes, it's funny.
I think the idea is great for people in our business. You should call those people and follow up. You should also ask for referrals, by the way, from your current clients and say, who else could I be helping? Who do you know that I could help? Right. But tell me, Kenny.
Listen, it's 100%. And it's funny you say that because I got a call on Monday from a new client, somebody who just knows me, sees me on TV, blah, 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 been kind of watching me, who then called up and said, look, I need to leave where I'm at because I'm not comfortable there. They never call me. They're not paying attention, blah, 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 all this other stuff. So we had this whole conversation about, kind of tried and true and slow and steady wins the race versus, to your point, right? The guys that were trying to, hit a home run at every single play was trying to be a home run. Meanwhile, you and I, we're kind of slow and steady, right? You got a couple of home runs, you got doubles and triples, and you're fine. And so I think that's exactly right, is that's what investors need to understand, especially during times like this when it gets clearly volatile and it causes anxiety for a lot of people. And, I say to people, if you're really, really stressed over what's been happening, then maybe you really need to look at either your portfolio or maybe you need to talk to your advisor about what's in that portfolio. Like I said, because this is very normal what's happening, and you need to make sure that you have a portfolio that reflects who you are, where you are in the life cycle, and what your goals are, to your point.
Well, when it's gone up huge. And when it goes down, whoa, get out of the way, get out of the way.
And that's what we've seen happen, right? And some of these high-flying names. Now, some of the high-flying names, the ones that are getting crushed, are also the ones that so outperformed on the way up. So, when you look at a name that was up 800% and it pulls back by 20%, I don't know why you're having a nervous breakdown, right?
But no, but when you sign up for volatility, you got to know that means downside volatility too. Volatility is not a one-way street.
100%. And so that's why guys like you and me, kind of the slow and steady, long-term focus, doubles and triples and an occasional home run is much better than someone trying to hit a home run every time and failing.
Give me my quick Art Cashin story. I was on the floor to do a hit for CNBC, and they wanted me to be the slow money guy with some hedge fund manager who was up 1,400% in the past year. And Cashin looks at me and he goes, oh yeah, you remember that guy like 7 or 8 years ago was up like 1,200%? I said, no. He goes, that's right. See ya. Good luck. Those guys come and go was Art's point. You've been here for 14 years, Farr. You'll be here for 14 more years. Why? Because you're a slow, steady guy. You keep getting it. You keep doing it. And you don't try to do 1,400% because you can't.
And you're handsome. Let's be honest. You're handsome.
Well, and I'm relatively young because somebody here is having a birthday, And let me tell you, I'm going to answer the question now before you ask it. I will still love you when you're 64. Okay. I will still love you when you're 64. It's next week, folks. Send your cards and letters to Kenny Polcari. You got to do it. It's the big birthday. Show some love to my buddy Kenny. Kenny Polcari is CEO of Case Capital Advisors, Chief Market Strategist for Slate Stone Wealth, my very dear friend. Happy birthday, Kenny, from all of us at the FarrCast.
Thank you.
Coming up.
I'll see you the next time. You got to call Harry. You got to call me the week before his birthday so I can do the whole same routine.
Harry, there's not a lot of job security in that, but give it a try. All right, Mahaffee, coming up. Please stay with us.
Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back. Joining me now, as he does every week, Dan Mahaffee from the Dr. Scholl Foundation, where he is the president. Also, Center for the Study of the Presidency and Congress, where he is a senior scholar and the senior political analyst on the FarrCast. Welcome back, Dan.
Good morning, Michael. Good to be back talking with you.
It is good to be back talking with you. So let's start. Find a cheerful note. Dan, you were wrong. You were wrong. You were wrong.
Let's own it.
You were wrong.
I'm quitting today to start my meteorology podcast since we went from thunderstorms to snow here in Chicago, and apparently that was an easier prediction than the government shutdown. But it was the shutdown that wasn't.
You still keep your job, so why not?
Yeah. No, so it was the shutdown that wasn't, and I did caveat my prediction with something seismic would have to happen, and I think that is what Schumer did that night when he came and said he was going to cross the aisle and keep the government open. Now that has had consequences. The quote going around from within the Democratic caucus is right now that Schumer's internal popularity is near somewhere between Elon and Ebola among the Democrats, as it was put. So Schumer's not popular for doing this. And I think it really disappointed a lot on the Democratic grassroots, folks outside the Beltway, others who wanted to see Democrats at least stand up for something for a little while, even if it was going to cause, 48 to 72 hours of uncertainty. So that's ultimately, I think, the issue there is it really shows that the Democratic Party has yet to coalesce on how they want to push back against this administration. And those critical of Schumer will point out, look, the Georgetown law dean has appeared to have a stronger response to the Trump administration than the leader of the Democrats in the Senate.
Okay. So what was the political calculation that Schumer made in crossing the aisle? What does he think he was trying to accomplish, please?
Two calculations. One, that no matter what the current media environment, Democrats don't have their head around it and they would take the blame for whatever shutdown. And two, that in the absence of a spending package, Trump would have too much authority to cut and close, as it were, without Congress saying these programs need to stay open. So that was the sacrifice I think he thought that was going to be made. But again, it's really angered House Democrats, grassroots Democrats, and even some in the Senate itself.
So did he make the right calculation, do you think, or not?
I think the jury will still be out on that. I don't think he stays on his career probably as the minority leader is in question. Look, I think we avoided the damage of a shutdown, but it's a question of where is the pushback? What is the resistance? And I think that really does give people pause about, is there going to be a virtual rollover by the party as the Trump administration seems to pick up momentum?
Had we enjoyed Minority Leader Senator Mahaffee, would Senator Mahaffee have crossed the aisle? Do you think it was a reasonable calculation?
I would not have crossed the aisle that night. I would have tried to use the weekend to at least get some concession out of a short shutdown. Try and negotiate something, but to just roll over entirely, no.
And that would have been politically, I think, probably very wise. It would have showed enough resistance. It wouldn't have, yes, it would have given
and logistically, look,
would have given you cover to roll over anyway.
the House, you could have it could have extended up to a week, but you would need to, just still some resistance, use some leverage you have in that at that point.
Okay, fine. Uh, Canada seems to be getting more heated. Can we talk about Canada and then see what's going on in Russia and then the silence, the tomb vault-like silence that has become both China and pretty much the Middle East, though more conflict from Hamas, but no word from us. Interesting. Canada first, please.
Canada, look, I think Trump, in many ways, provided a rally around the flag effect for the Canadian leaders. And particularly now that you have Mark Carney, who's been a central banker and climate advocate for so long, now that he's taken the post, look, the Liberals in Canada seem to be doing well. They are united in pushing back against the U.S. and any election there. It looks like now that the baggage of Trudeau is gone, the Liberals have probably the best bet at a majority in their parliament than they've had in some time. Like the British, they have a parliament where it'll come down to, what party has the majority to make a prime minister.
Where does this end with Canada, Dan?
That's the question of the end game with this, because I don't see the clear strategy that Trump has with Canada. And that's continued to be the question. Is he beating up on Canada because it's a way to show he's serious with some other ones, kind of mentality of slap around the little guy in your gang to show the other guys how serious you are? Is it that mentality, or is it part of a broader, again, how do you renegotiate these things like NAFTA, now USMCA, things he did during his? Is it trying to create a different trade regime? But again, I'm not sure, because he previously thought that USMCA was one of his great accomplishments of the first term. So where these things stand, I think it's more in the absence of a clear strategy. It's a back and forth until he feels like he's prevailed ultimately. And I don't know what the criteria is for that.
Jay Powell said that he thought, Kenny was talking about this, that perhaps the inflationary pressures of tariffs could be transitory, which doesn't make Kenny happy. Just that word, he doesn't like it. But transitory. But I said, my response was, well, if the tariffs are transitory, then the effects would be transitory. But if the tariffs aren't transitory, then the effects will not be transitory either. And this just all depends what the president keeps in place and or lets go. But I think there's another point here, Dan, and this is to me very important, and I need your help. If President Trump seems to feel that the rest of the world will respond, and if he lowers tariffs, they will immediately lower tariffs, and that he can put as much gasoline back in the economic engine as he wants when he wants. What if these counterparties in Canada, Mexico, China, and other places? Now I just went through 45% of our trade partners in Canada, Mexico, and China. What if they go, oh, you lower whatever you want. We're tired of you jerking us around. We're going to keep our tariffs.
Oh, sure.
What happens then? And would they do that? Or do they have to play ball with the United States?
Look, there's a certain point where they still have to play ball with us because of our size, but they increasingly look to design a game without us. That's the ultimate law.
How do they do that? How do they do that?
Well, you see them start to look at building their own trade regimes. You'll look for China going to Brussels to set up a trade deal, or going to Latin America. They'll have, more Chinese investment in Mexico.
Going to set up a trade deal with Brussels?
Well, that's the entire European Union. These powers will go on without us they'll look to de-dollarization. Yeah. They'll look to other ways to do business without involving the United States.
Economists will tell us that they really can't do de-dollarization in any reasonable period, and we'll certainly be through the Trump next 3 years and be back to the races. Do you think that's naive?
I think it is naive with digital currencies and ways you can do things now. I think a little bit of overconfidence and a little bit of a mentality of it's not a problem until it is.
Get me to Russia and Ukraine now and give me your best read on what's happening there, because it doesn't look like much.
It doesn't look like much. I think what Putin is trying to do is draw out the negotiating process, really try and keep pushing militarily, even while we're putting pressure on the Ukrainians to come to a ceasefire. But look, I think the tone between leadership in Ukraine and Washington is much more positive than it was in past weeks. So you can take some heart in that. But Putin's going to continue to try and draw this out as long as possible to take as much territory and really get into the weeds when it comes to any kind of deal for the future.
David Ignatius wrote an article yesterday and said it basically comes down to this. Putin's going to keep putting off Trump and the Ukraine and everything else until the president does one of two things: either sort of backs off, walks away, and leaves this where it is with a couple of Pyrrhic victories, perhaps, or he actually comes at him hard and says, "You're going to do it. You're going to do it this way, and I'm putting the full power of the United States behind Ukraine if you don't." People are thinking President Trump is not inclined to do that, but it's got to come to one of those things, doesn't it? Because Putin's not going to give up unless he's absolutely forced. I don't think, and neither did David Ignatius. What do you think?
I agree with David Ignatius on that, and I think it's again the question of, as we've raised in a previous podcast, is the commitment to Ukraine one that historically will look like our relationships with Japan, Britain, and those countries, or is it going to look like our history with Afghanistan, South Vietnam, others like that?
You have a bet?
My bet is unfortunately that the attention goes elsewhere, as David Ignatius rightly said, that it kind of comes into, as Putin likes it, these frozen conflicts on his periphery, Georgia, Ukraine, those types of ones. He likes to have these countries destabilized so that Russia can prevail. And if the presidential attention span goes elsewhere, that'll be the outcome. I think ultimately, if someone can advise the president that his attention and his pushing Putin to the table would be seen as a Trump victory, most importantly. However you can package that to explain that to him, I hope his advisors are.
Okay. So you're thinking more of an Afghanistan moment for Ukraine. It feels that way, Dan. It feels that way, but this is your area of expertise and not mine. So I hope you're wrong. I hope we have more of a at least a UK Britain kind of an experience there. Let's go to quickly the Middle East. What's happening with the ceasefire? And I got to go. I'm sorry. But
ceasefire broke down. No more hostage exchanges. The terms of it, I think the calculus again that the sides are just pausing and rearming is there. What I'll also keep an eye on though is the U.S. and us. We've been with our allies really stepping up strikes on Yemen in the past few days, really trying to go after the Houthis. So does that invite further retaliation by Iran and other fields? We'll have to see there. But I don't think the respite that we had from the ceasefire is going to come back anytime soon.
Not coming back anytime soon. We're back to the fighting in the Middle East, at least in Palestine.
Yeah, and I think look in Gaza, specifically, I don't think you see the same kind of incursion because there's not much more than rubble there right now anyway. But this tends to be just a period of airstrikes, raids, things like that.
Oddly feels like a win, certainly for Netanyahu. Would you agree or no?
Well, I think it is a win for Netanyahu, and I think he's also pleased that because with the ceasefire collapse, one of the far right parties has come back into his cabinet, and that also shores him up politically.
Dan Mahaffee for the Dr. Scholl Foundation, Center for the Study of the Presidency and Congress, our senior political analyst on the FarrCast. Thank you so much for being with us. This is great.
You're welcome. Thank you, Michael.
It's great. All right, coming up, Dr. Jay Bryson, Chief Economist, Wells Fargo. Dr. Jay Bryson, Chief Economist, Wells Fargo. What a treat. Stay with us, please. We're going to be right back.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, a FarrCast fan favorite, and I will tell you, a Farr fan favorite, Michael Farr favorite. I'm a big fan of Dr. J. Bryson, chief economist at Wells Fargo, has been a great friend of mine for 30 years now, maybe slightly.
Who's counting, right?
But well, we can keep count because we met when we had children, and that's when our families got to be friends, and we have children the same age, and those children are now in their 30s. So we can do that, Jay. We can come up with that number. Jay was working for the Federal Reserve back then, really as an understanding of policy and everything else. Pretty much second to none, and understands the politics inside the Fed. So, Jay, let's just start there. What did you make of this week's, meaning yesterday's meeting, and the speech by Powell, the positions, and what they had to say?
Well, I think I would sum it up by what the FOMC said in its statement, and that is the economic outlook is uncertain at this point. You see that in terms of what's happened to their forecast and everything. It really boils down at the end of the day to what's the outlook for trade policy here. And, we don't know exactly what the individual FOMC members are assuming about trade policy, but when I look at their forecast, the fact that the growth forecast got ratcheted down while at the same time the inflation forecast got pushed up leads me to believe that they are incorporating some sort of tariff assumptions into their individual forecasts. And what it means is, they're kind of on wait and see sort of, view here about, what's happening to the economy and how do they respond to that in terms of policy.
I gave a speech with Pat Harker last month at the University of Delaware, and I've done this now for something like 18 years with different Fed presidents, though this is the third or fourth one with Harker, and he and I have gotten to be friends. And when we were talking before the meeting, and I was, asking him a number of questions, and he goes, the tough part, Michael, is the Fed can't make policy on hypotheticals, and I really can't answer questions on hypotheticals. You start going down different rabbit holes that just aren't productive and get everybody all upset. And I thought, gee, that was a really good way to say pretty much what Jay Powell said yesterday in a bit of a different way, which was, we believe that tariffs will be transitory. And then he said, unless they're not, kind of. And if they're not, and if the President Trump holds with these tariffs, then you can kind of make clearer economic assumptions. Can you not, Jay?
Yeah. So I think the important point here is what you just said, is if President Trump holds to those sorts of policies. And, I do believe, in theory, tariffs should be, quote, I'll use a bad word here, quote, transitory. In other words, you put the tariff on, it raises the price of the good. And as you are moving from the pre-tariff price to the post-tariff price, that brings up the price level. You have a bout of inflation through that period, but assuming you don't continue to double down in a trade war, once the price level settles at the higher sort of level, then the inflation should subside going forward.
Right.
But the question here is what happens to inflation expectations in the meantime. So, Michael, you and I can think back to the 1970s, the 1980s, and if you remember back then, with those OPEC supply shocks, what that did is that unmoored inflation expectations. People continued to expect higher and higher inflation, and when that happens, it becomes kind of self-fulfilling. In other words, if you think the price of a car is going to be 25% higher next year, you've got a real incentive to go out and buy that car right now. And if everybody does that, guess what happens? It pushes the price of the car up and you have a higher inflation.
Right.
And so the key thing here is that inflation expectations, nobody really knows what's going to happen there. And, the Fed is just going to have to be watching that through surveys, through what's happening in the financial markets to determine what's happening to inflation expectations and how to respond to that in terms of policy.
One of the things that they said was that they don't see a lot of wage inflation, meaning not a whole wage inflation putting pressure on inflation here. That in many of the surveys, we're still going to be looking at a 4.3% kind of unemployment number, still considered full employment. And in fact, your reports have been saying that you think there could be a softening actually in employment coming into the fall towards the end of the year, if I'm reading your stuff correctly. So you're not seeing wage pressures and wage inflation, which both have been pretty big, right?
Yeah. But so what's happened over the last 2 years or so is, so before the pandemic, wages were running at, let's call it 3.5% year over year.
Yep.
The pandemic comes along, people fall out of the labor market, they stay at home, whatever, right? The economy gets kind of overheated and a wage inflation goes up to about 6%. What's happened is that's kind of subsided back down to 4% here. And so our guess here, our view would be, if you do have tariffs and it does cause growth in the economy to slow down later this year, yes, that does push the unemployment rate higher. You probably do get some more wage moderation in that. So our view here is, if you do get a tariff sort of increase, it will be, again, to use the bad T word, it will be potentially transitory. And eventually the Fed will be cutting rates. Yes, inflation goes higher, at least initially, but that should be just a one-off sort of thing. And then as the unemployment rate comes up, the Fed starts to react to that and says, you know what, if we don't do anything here, you could get a downward spiral in terms of the economy really starting to soften in terms of going into a recession. And so we need to have more accommodative policy, and we're looking for some rate cuts at the end of the year. But I'd be the first to acknowledge, and I'm going to go back to this word that the Fed used yesterday, there's just a lot of uncertainty right now as it relates to the economy.
Does it feel schizophrenic to have one side of the government on fiscal policy having a tariff war that's putting inflationary pressure on, while the other side of the house that was trying to get and making progress in getting inflation under control now has to lower rates to kind of offset another government policy? I mean, this feels like policy-driven inflation in a strange way. I feel like it feels schizophrenic to me. What does it feel like to you? You're the economist.
Well, yeah, it's uncertain, schizophrenic. I mean, whatever you want to. Yeah, policy is kind of moving in two different directions here. The Fed is trying to bring the inflation rate down right now, but some of the economic policies of the administration potentially could be inflationary, at least in the short term. I mean, tariffs certainly are. And we know that the empirical literature shows that what happens is domestic either producers or consumers have to pay for at least large parts of the tariff. It gets passed on to consumers. That turns out to be, kind of inflationary. And if you're really cracking down on immigration, that hurts the growth in the labor supply, which then could potentially lead to higher wages. So, yeah, to use your term, Michael, it is a little bit schizophrenic. It's policies going in kind of two different directions right here.
One of the things that I think we assume as we go through these sort of tariff negotiations is that the counterparties will react in a timely way, particularly if we look at Canada, Mexico, and China as U.S. three main trading partners, and we have tariffs. They react to tariffs. If we lower the tariffs, there's an expectation that they will lower tariffs. What happens if those counterparties kind of get sick of our tariffs and decide, nah, we're not going to be all that accommodative. We're not going to react to your lower tariffs. We're going to try and play harder ball longer this time. Is that something that's possible, so that Xi Jinping and others can just say, President Trump, we're not going to play? And so you think you can lower your tariffs and get your economic activity started again when you want to? Maybe you can't do it according to your calendar if we won't play.
So I'm going to interrupt you here. You were saying lowering tariffs. Did you mean raising tariffs?
No, I mean after we raise the tariffs, I'm looking down the road because there's this
Oh, okay.
notion that's been posited that says there's something here that President Trump could be causing sort of a sharp, brief recession with tariffs that he will be able to cure by the midterm election. And I think that that's a very perilous strategy because you can't turn the economy. The economy doesn't turn on a dime, more or less somebody's ability to turn the economy on a dime.
Right.
But I'm just thinking there are a lot of unforeseen consequences here that maybe are really less foreseen than in other times. Can that happen? I mean, do you see where I'm going here? That maybe
So
this could take a while.
in other words, we put tariffs on China, right? And they
Yes.
respond to tariffs, and then
Yes.
the economy's going into the crapper here, and so we say,
Yes.
okay, we're going to reduce our tariffs, and then China says, you know what, screw you guys. Terry, you're not recording this, right? The heck with you guys. We're going to keep our
Exactly.
tariffs kind of higher.
Exactly.
Um, so I think that there is a potential risk of that happening. That we kind of get into a trade war with some of our bigger trading partners, and then we eventually lower tariffs back to where they originally were, but the other guys don't play ball and they keep them at higher levels. I think there's a possibility for that. I would put that as a relatively low sort of probability. I mean, it's particularly in the case of Canada and Mexico, and we're the dog that wags that tail, and I don't see them trying to force a trade war on us. And so if we were to eventually reduce tariffs on Canada and Mexico, I think they do kind of the same sort of thing. Same thing with kind of the European Union. I mean, I think they still view us as allies. China, I think maybe could potentially be a little bit of a different sort of issue. But that said, China's got a lot of problems right now, economic problems. And kind of the last thing that they want to do is if we're willing to ratchet down trade tensions, I think they go for that just because they've got a lot of economic problems over there, and they don't need something else that's causing their economy to slow.
Is there a risk here that the dollar actually loses its status somewhere as part of this process between crypto and cyber currencies and digitalized currencies and everything else, with all of the other options out there and a growing antipathy towards the United States? What would it take for the dollar to lose? Because I'm getting this question from clients and people when I'm out speaking, and this is on people's minds.
Yeah. So why is the dollar? Let's start at the very, very beginning. Why is the dollar the world's reserve currency? Well, part of it is it's the largest economy of the world. Part of it is the largest military, et cetera, et cetera. But one of the most important reasons here is the deep, liquid, transparent financial markets of the United States. People invest here because there are tons of investment opportunities. They buy our stocks, they buy our bonds, they buy our real estate. And in order to do that, you need dollars to do that. I said transparency. When you talk about China and you say, okay, I'm going to say the word China, tell me the first 10 words that come to your mind. I can guarantee you for most folks, transparency is not one of them.
Correct.
And so, right. So
that would be one of the last.
Probably one of the last.
Yes.
China is not a really great place for people to invest. As a matter of fact, you just don't see a lot of investment there. Europe is a little bit different, but their bond market, particularly their corporate bond market, just isn't the same sort of depth and liquidity as what the U.S. is or their stock market. So the biggest way that you lose reserve currency status is that you do something that inhibits that capital markets or the capital markets free flow. Now, one thing that I'm a little bit concerned about is the so-called Mar-a-Lago Accord, where they're trying to bring about a weaker dollar, much like the Plaza Accord back in the mid 1980s. Michael, you may remember that, right? This is where a lot of people got together at the Plaza New York in Plaza Hotel in New York and tried to bring the dollar down. Well, they were extremely successful doing it. It came down by 40%. And and part of the problem is when once the dollar starts to depreciate and people think it's going to continue to depreciate, people don't want to buy dollars. You don't want to be buying a depreciating asset, right? And so it can get out of hand. And then that, real depreciating dollars tends to raise inflation here. So kind of be careful what you wish for.
Yeah, no question about it. These unforeseen consequences. So, Jay, what's keeping you awake at night now, or are you reasonably sanguine about the U.S. economic outlook? Are we going to get ourselves in trouble here from otherwise having been at a relatively decent spot?
So in general, Michael, I tend to sleep pretty well at night. I mean, I guess the thing that would be is the concerning.
Nobody our age sleeps really well at night.
Well,
Jay.
In a relative sense.
Oh, relative.
Right?
Okay, fine.
Yeah,
I got it.
Relative to you, I may be sleeping better at night, right? I guess it's just the uncertainty here. There's a lot of geopolitical uncertainty out there right now, and so that obviously is something that could upset the apple cart here. Trade wars, when they start, they could have a lot of bad consequences. They can kind of start to spiral out of control. In general, I would say the underlying economic fundamentals of the U.S. economy today are pretty good, right? This is not 2006 where you have a housing bubble or anything like that. The fundamentals are pretty good, but it's the unknown geopolitical policy uncertainty environment right now that is bringing some concerns, I guess.
Overall, Jay, we're hearing we've got to return manufacturing to the U.S. We've got to return jobs to the U.S. We want a more U.S. centric, U.S. based kind of an economy. Dan Mahaffee asked me the question, and he said, isn't basically dismantling 40 years of globalization fundamentally inflationary? What do you think?
Well, so it again, what happens is it raises the price level, right? So why do we buy imported goods from China? Because they're cheaper. Okay, so we start bringing some of that stuff back, and that's going to take years, right? It's not like we have lots of ability to produce Apple iPhones here. That gets all assembled over in China. It takes years to build a manufacturing plant. So it does raise the price level. Now, whether it becomes inflationary as in the 1970s, that's going to depend on how the Fed, what the Fed does. At the end of the day, the inflation rate is going to be controlled by the Federal Reserve. If the Fed accommodates that supply shock by having really, really loose monetary policy, then you could potentially end up in a 1970 sort of situation. But, knowing this Fed, I don't think they become, that accommodative like they were back then. The underlying structures of the economy are completely different than they were in the 1970s. And so what I think you potentially could have would be a period of slower growth as this disruption works its way through the economy. But the last thing I would say here is, talk about manufacturing, bringing manufacturing back, bringing manufacturing jobs back. Okay, that's great, right? But we are not going back to 1955. That's just not going to happen, right? And back in 1955, manufacturing accounted for 25 to 30% of the overall workforce. Today, it's less than 10%. Yep. So you could bring you can bring factories back to the United States to produce goods here, but it's not like you're going to be bringing thousands and thousands or hundreds and thousands of millions of manufacturing jobs here, because manufacturing today in the United States, it's all automated.
Yes.
Right?
Yes.
Right. This is not our grandfather's factory sector where you had thousands of people on factory floors. Today, you have, just a handful people to turn on machines and turn off machines.
I said at that speech, let me see. Yeah, I think I said at the speech with Harker, as people are saying, we want more manufacturing back in the U.S. and we're going to create more jobs. And I said, hey, folks, we don't need either. We don't need either. We've got 4% unemployment. For God's sakes, don't start creating jobs right now. We're just trying to fight wage inflation, and you start creating a whole bunch of jobs with this many people with not a very unemployed workforce. You get me back at wage inflation. Number one. Number two, you've got to pay 3 or 4x for U.S. labor, and all of a sudden that flat screen TV for $300 is now $3,000 again. And it is that kind of a jump on some of these goods that come in. So there's a reason that we sourced more efficient prices over time. And boy, did I catch hell for that after I walked out to the reception by folks who thought that I was some sort of a communist saying that we didn't need, more U.S. manufacturing and jobs. They did make a good point. They said, listen, we've got to make penicillin here in the U.S. We don't make any penicillin here in the U.S. We need to build more ships. I said, listen, the priorities of what we need to do for security reasons are perfect. I get it. Yeah, I agree with that, but not as an economic fundamental need here. You're talking about a national security need, not. So what did I get wrong?
Well, I think you generally have it right there. So I guess what I would quibble about there is, you say flat screen TV goes from $300 to $3,000, and what I would say there is, so there's it's not like you're going to replace 100 Chinese workers with 100 American workers, right? You're going to replace 100 Chinese workers with 10 American workers, right? How we do it here is much more capital intensive than what they do over there in China, and so the prices wouldn't go up by that amount, but they would go. Again, the reason why we buy stuff from China is it's cheaper to do that. The second thing I guess I would say it would be so. If, from national security reasons, you decide that we need to make more, chips, computer chips here, or whatever you want to do, economic theory shows us that that's a valid reason. But the best way to do that is not to put tariffs on goods. The best way to do that is subsidize production, like the CHIPS Act, the Inflation Reduction Act, things of that nature, which, some people in Washington are talking about rescinding. And I look at that and say, that's crazy. If we want to have more chip production here, we should be subsidizing it. Don't put tariffs on it, because that's just going to raise the price for everything, and subsidize it instead.
I'm pretty sure that Ronald Reagan said you don't get more of something by taxing it. Reagan had a couple of those lines. If you want more of something, you don't put a tax on it. The subsidy certainly makes sense. The CHIPS Act certainly made sense to me for just those reasons. So let's look broader term, and we've got to go because we're out of time. But God, I always learn so much when I talk to Jay Bryson. This is so cool, and you're great to be with us. Thank you, Jay. Really, thank you. You and I have seen big economic cycles and swings. People get very upset. They get very dispirited. My more liberal Democratic clients, half my clients are Democrats, half my clients are Republicans, and the Republicans are largely happy, and the Democrats are largely suicidal when they get me on the phone. What do you tell those people as an economist when we go through these cycles that seem to be contractionary, necessarily or unnecessarily? How do you tell them to deal with it? And what's your long-term expectation? Where do you think the U.S. economy is in 10 years?
So, it kind of goes back to our conversation that we just had about, the reserve currency of the reserve currency status of the U.S. dollar. As long as we don't kill the underlying good fundamentals of the U.S. economy, we still are the world's best innovator. We still have open capital markets. We still have free enterprise here. As long as we don't kill those sorts of things, I'm generally bullish on the U.S. economy. Do we have issues here? Do we have some fiscal problems? Do we have some debt and things like that? Yes. Right. But I think they're all manageable sort of questions. Now, you have to have adult conversations about how to deal with some of these issues. But it's a lot easier to solve some of those problems when you've got a lot of resources like the U.S. economy does, when you're growing, it's a lot easier to solve some of those problems than when you're not growing and you don't have some of those resources. So again, I think the problems that we do have are manageable. We just need to everybody just needs to step back, take a deep breath, and try to work together.
I lied. I have one more question. I have one more question, because part of what you're talking about with U.S. manufacturing goes not only to mechanization, computerization, but we're talking also about AI. And folks have argued with me. I think AI continues to probably be the most powerful force I'm seeing behind the U.S. economy right now, adding to that productivity in I think ways that will be exponential over the next 5 years. And certain people shake their head at me and go, this is just because you don't understand technology well enough. It's not that big a deal. And I think, well, I can never argue with not understanding technology well enough, because I am old. But this I think is being underestimated. And those 10 factory workers instead of the 100 factory workers, I think could go to 5 or 4 or 3 factory workers once AI learns how to do it. Am I right, wrong, or are they?
Well, so I think AI is more of could be potentially more disruptive to the service sector than it is to the manufacturing sector. So there's a lot of jobs that could potentially be AI'd away, if you want to call it that. But there's also jobs that it's very, very productivity enhancing for as well. And so it will be like any technological change. It will be disruptive. It has the ability to be a productivity game changer. I don't think in the next year or two, people are still experimenting with it. I mean, I think it's more of a next decade sort of thing than it is potentially right now. But it will be potentially disruptive. And as long as you have the smart public policy in place, and let me rephrase that, as long as you have smart public policy in place, you should be able to manage your way through it. The people who are displaced because of AI, we want to retrain them. We want to retrain them for things that aren't going to be AI'd away, like electricians and plumbers and skilled sort of things of that sort of nature. It's going to take a lot of smart public policy to do it. But the worst thing that we could do is stick our head in the sand and say, no, we don't want to embrace AI. Yes. It would be like the Luddites in early 19th century Great Britain smashing all the weaving machines. That would have been the worst thing that could have happened to Great Britain, at the time.
Well, every time I talk to Jay Bryson, I certainly feel like a Luddite, but less of one after I finish talking with Dr. Jay Bryson, chief economist at Wells Fargo, my great friend. Thanks so much for being with us on the FarrCast.
Thanks for having me, Michael.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world to help us better understand what's going on, how we can make sense of it, and leave us all, and me especially, a little bit smarter for the week, a little bit better prepared to make the decisions we have to make day to day facing our lives and our futures. Stay the course, stay calm. Whether it's evident to you or not, the universe is probably unfolding as it should. For my producer, Harry Jennings, everybody at Hightower Advisors and Farr Miller and Washington, thanks so much for listening. Please share us on your social media. We will be back again next week. For everybody at the FarrCast in Naples, Florida today, I'm Michael Farr. See you next week.
Thanks for joining us on this week's episode of the FarrCast, and thanks to our guest, Kenny Polcari, Dan Mahaffee, and special guest, Dr. Jay Bryson, Chief Economist from Wells Fargo. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. In the next 2 weeks, I'll be traveling, but we will try to get out brief episodes to you to help you keep up with weekly changes in the economic, financial, and geopolitical landscape. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, that it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep those emails and messages coming. Take care, stay safe, and stay healthy. Thanks for listening to the FarrCast, Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.